Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money, where we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb, and this week I am welcoming back to the show Bloomberg personal finance and investing reporter Suzanne Woolley. Welcome, Suzanne.
Great to be here.
Well, it's a difficult time to think about what to invest in, isn't it? So it's lucky that we have your go-tos. I mean, we're sitting here, aren't we? And there's been a wonderful run in markets, and now there seems like a little bit of an AI wobble going on, and there's more and more talk about, is it a bubble? Will there be a crash? What will happen? What do I invest in if I can't invest in AI because AI is the only thing in the world to invest in, etc., etc.
Exactly. And gold, you know. Gold
wobbling.
Has had a little...
Oh, kind of wobbling, but hanging in there around 4,000.
Yeah, no, I'm not going to knock gold.
Yeah, everything's going to be fine with gold. Surely. Anyway, you have been out there interviewing again, asking people who really work every day in the markets what they are investing in or what they would invest in, and also crucially what they do if we just gave them $1 million and told them they could do whatever they wanted with it. That's the most interesting bit of all this, I think. I mean, we're interested, aren't we, in what they think about, metals and all that kind of thing, but what we're really interested in is what they do with $1 million.
Exactly.
Right, let's talk about your first interviewee, Alexandre Tavazzi, who is... from Pictet Wealth Management, and he is a man after my own heart because for him, the future is metals, right?
Yes, yeah. He is really focused on a structural bull market in raw materials. I mean, his line is, the infrastructure of the future is being built today and it's metal intensive. So, we're seeing record demand for materials like copper and lithium, materials that sort of give you access to the physical backbone of tomorrow's economy. He likes asset-heavy companies in the space, so companies that have significant physical assets like smelters, refineries, land, and real estate. In part, this is because they provide an inflation hedge as commodity prices rise. So he would deploy the $1 million into 3 buckets. He'd put about half in a diversified group of global mining companies with exposure to copper, aluminum, nickel, and rare earths. And that's because he calls them the building blocks for grid upgrades, for electric vehicles and battery storage. And then he'd put about 30% to direct commodity ETFs, again, copper, aluminum, and an array of battery components. Further, he likes their inflationary status, and they provide a good sort of more direct play on metal prices. For the final 20%, he would just target public companies that are sort of the picks and shovels needed to build energy infrastructure, grid connections, power inverters, advanced storage systems, all of these sort of basic building blocks of the infrastructure that we're going to, no doubt be needing well out into the future.
Yeah. I mean, this is so interesting because it's something that we talk about on the podcast a lot. We talk about, will there be a commodity super cycle? We talk about inflation and how you hedge against inflation. And in particular, over the last year or so, we've been talking about the price of AI companies. So if you buy a company that's directly involved in the AI revolution, it's going to be extremely expensive on every single valuation measure.
So true.
The companies that allow the AI company to even begin to exist, the companies that produce the metals and the products that allow the grid to be upgraded and data centers to exist, etc. You can buy those for almost nothing. So it makes so little sense. So this strategy, to me, it seems incredibly sensible. You want to be invested in the future, but you don't want to pay a PE of 70 times to be invested in the future. You'd rather pay a PE of 10 to 15 times, even less in some of these cases, to be exposed to the building blocks behind that technological revolution.
Absolutely. I think it's a really sort of solid argument. And with AI today getting in where the prices are, it just seems kind of insane to me.
Yeah. Now, Alexandra, he also, as far as I can, Alexandra, he has in his mind AI across the board, I'd say, because when you asked him what he'd do with $1 million outside this more conventional investment approach, he immediately shifted to worrying about the disruption to any work or careers that his children might have in future and the need to give them some kind of cushion, right?
Yeah, that's a great point. He did. He talked about how young men and women today entering the labor force are confronting these massive challenges of technological change, geopolitical order being reshaped. And so he would give the 1 million to his kids and sort of free them up to focus, he said, on the opportunities of today rather than the uncertainties of tomorrow, to sort of free them from worries related to potential work disruption. So it was a really interesting way to spend the money given what his main entry was about.
Yeah, it's interesting, isn't it? Giving your kids the gift of freedom.
I would take that.
Yeah. Although for another podcast, of course, giving your children too much money can hamper them horribly. You have to find the sweet spot, don't you, between taking away a good bit of the pain, but also leaving them in need enough to drive them to self-fulfillment. We all know the miserable trust fund kid.
Yeah. And if they have sort of money all their lives and they don't encounter sort of any sort of difficulties, how did they develop resilience?
Well, resilience and self-fulfillment, that's what we all need. Anyway, that's not for this podcast, is it? That's a different one. In fact, we should do a different one. We should do a podcast on inheriting wealth.
That would be great.
Not just on how much is going to be inherited, because we talk about it all the time, but the emotional and productivity side of inheriting wealth. Okay, stand by for that one, listeners. But let's move on to, in fact, let's stick with luxury. Then you spoke to Chloe Duanchi, head of macro and investment strategy at the Rockefeller Global Family Office. Well, I bet they know what they're doing. And she was all about luxury real estate.
Yes. She was saying that there's a lot of interesting opportunities unfolding in some of the more niche thematic corners of luxury real estate development, such as premium student housing at state universities in the U.S. and in really high resorts. Because as we know, while the average U.S. consumer, the low-income consumer, is under pressure, and we're starting to see cracks show up in the financial pictures there, the market looks very different at the top of the income spectrum. We had that statistic out of Moody's about how much of consumer spending, I think it was about 50% of all consumer spending in the second quarter, was done by the top 10% of U.S. earners. And that is huge. So that is an area where spending by affluent households, it's far more stable across cycles, she was saying, and that resilience is what people will pay a premium on, which makes a lot of sense to me. She thinks that part of the story to this, her real estate development idea, is the supply vacuum that we saw created by a number of years of limited new construction, when new builds virtually froze during 2022 and 2024. So she's playing this sort of collision between scarce new supply coupled with sort of steady, if not improving, demand. And with student housing, she says that at first I thought she was going to say, premium student housing. I thought she was going to say, Harvard or Yale or some of the really elite opportunities. But she was still saying, very good flagship state schools with big sports teams have seen resilient enrollment and a lot of growth. But the supply of student housing hasn't kept pace, even as rents have popped up quite nicely. And it's not an imbalance. It's likely to go away soon, because to be a player in this space in student housing, you have to have a lot of history with that area. You have to sort of know the local politics. You have to know what the local entitlements are. You really have to it's a very specialized niche. So you can't sort of easily parachute in.
It's interesting, it's not for everyone. How do you invest in that in student housing in the U.S.? You don't want to go out and buy a student house if you haven't got a student at that university. So you need to find some kind of fund or a collective vehicle for that.
You need to find a private fund, or basically you need to work with somebody like Rockefeller, a high-end, private wealth office that will have access to some of these players.
And the other thing that she talked about was experiences as the new status symbol. We don't want stuff anymore. We want experiences that we can put all over our social media and effectively get a longer-term return from.
Right.
And therefore the idea is that you should maybe have a look at some way of investing in luxury resorts and the developers that create those luxury resorts. Again, that's not for everyone, is it?
No, but it is an area where, as you'd imagine, the imbalance between supply and demand is very big, and it's very difficult to create one of these new luxury resorts. They want to be in amazing locations that often have sort of environmental concerns, and so it's an area where there's going to be no supply glut for sure. And, like she said, you have to partner with an uber specialized operator. And some asset managers will take external capital akin to private credit or private equity, but specialized players that have proprietary capital will sometimes take outside money. But it's not really something that you and I are going to go racing into, I don't think.
Your third one, you get through a lot of these people, Suzanne. This must be an awful lot of telephone calls. That's so interesting. This is Ron Sanchez. He's with Fiduciary Trust Co. International. He's the Chief Investment Officer. And he starts out in your conversation saying exactly the right thing, which is there isn't. Actually, no, he's wrong. He says there aren't quick, cheap investment ideas or opportunities today, given we're in the third year of the double-digit price increases for the S&P 500. Ron, look abroad. It's not compulsory to invest in the U.S. Other options are available. You could look at the UK where, we're pretty cheap over here.
Merryn.
Try emerging markets. There's all kinds of opportunities out there. Other alternatives are available.
I think there was a little home bias there, maybe.
Home bias. Looking inside, Ron does find something. The opportunities are narrow, they're select, but they exist in
healthcare. He focuses on healthcare. He, like you and like many people, is, concerned about the S&P and the level at which it's trading. And so he's, looking sort of digging deeper to find more active opportunities in the investment space. And I mean, his point is that for a lot of reasons, regulatory issues, drug price concerns, healthcare has struggled. And so he thinks it's trading at an attractive multiple. It's trading at a discount to the broad market that is much more than it has been in recent history. And he also thinks sort of from a risk management standpoint, maybe being in healthcare isn't a bad idea compared to, being in, say, NVIDIA and Microsoft and such a concentrated bet on tech in the S&P. He notes, NVIDIA and Microsoft combined to make up nearly 15% of the index, but the entire healthcare sector is 9% of the index.
That is a really interesting stat, isn't it?
Yes. And he also notes that it's one of the most diversified sectors in the S&P, with everything from drug companies to biotech to equipment makers and so on. And I thought, the really good point was, yes, there are near-term challenges for sure, but the demand for healthcare services and drugs is
not going away.
Not vulnerable. In the long run, it's not going to go away. We have aging populations here and in many of the major countries around the world. So demand is only going to become greater. So he feels like there's some growth opportunities in healthcare, but also it's a bit of a defensive play.
Fair enough. And quite interesting. If you're looking for any kind of value inside the US, that's probably an interesting place to look. But interestingly, when it comes to us saying to him, what would you do with $1 million outside conventional investment? Again, he's giving it to the kids too.
I know. He thinks, he said home ownership is the first step toward financial security. And so he would, he's talked about it with his kids, and starter homes are increasingly out of reach. So he would try to help close family members.
I mean, it's so interesting, Suzanne. I'm sure that we're not allowed to talk about your nice contacts like this, but I'm guessing this man has already had an opportunity to give money to his children.
I don't know.
So, I mean, I'm always surprised when people who you think have probably already made these plans, probably already have something in place for their children, etc. You give them $1 million and they give the kids more. What about the holidays?
I know.
Yeah, last time we spoke, everyone was going on holiday with $1 million.
I know. I have to say, it was more fun last time. We were fantasizing about where we would go in the Greek Riviera. Yeah.
I mean, I wonder if all these people saying that they'd give their money to their children, it suggests, when previously, even a few months ago when we were talking, we say to people, you want $1 million, what are you going to do with that? They'd be like, woohoo, I'm going on holiday. And now you're saying the same thing to them and then they're saying, oh, things are difficult, things are tight. It's Gary out there, I'm giving it to the kids. Is this giving us some kind of anecdotal sense of a shift in the way people are feeling in the US?
It's interesting. I think it probably is. I mean, there's this sentiment shift. And there's just, so much uncertainty, and we've got the shutdown, the government shutdown grinding on. I think it's sort of, a lot is very unsettled, and I think it's just, as time goes on, people have felt deeply unsettled for a long period of time. And I think it's even, seeping into the minds of people who probably would not be particularly concerned about their own financial picture, but it just makes everyone feel sort of vulnerable to change, to some sort of worrying about some sort of negative change. And so I think sort of maybe it's the lens at which people are viewing the world is just a bit darker now, and they're feeling more, protective and
more
defensive.
Worried about the kids.
Yes, worried about the opportunities. I mean, you see AI taking a fair amount of, entry-level jobs. And I think that is sort of leads to a very fundamental unease about what your kids' opportunities are going to be like going forward.
Definitely. Right. But we have one participant here who had a slightly different view on how to spend his $1 million. I think,
Yes.
we'd be keener on him. We'll come to his $1 million in a minute. But this one is Nick Frillinghausen, Co-Chief Investment Officer of Equities at the Chiltern Trust. And he has a slightly different idea. Again, we're on property here, but kind of the opposite to luxury property, right?
Yes. I mean, you're right. It's another real estate idea, and he says it's a patient idea. It's not an idea he expects to take off immediately, but over the next 3 years, he thinks home repair and remodeling space will be interesting. He has exposure to the leading companies in this area, the sort of what we call in the U.S. big category killer companies, as well as in the paint and coatings industry. And his feeling is that we've been in a housing recession for years with affordability at all-time lows, and we probably have a shortage right now of 3 to 5 to 4 million homes in this country. Existing home turnover is only about 4 million homes a year, which is a 30-year low. Typically, it would be more like 5 million or 6 million, or at peak, I think it was even 7 million. A lot of people are, as we know, locked into their homes because they have these low mortgage rates. But he thinks that if mortgage rates go about 100 to 150 basis points lower, that we're likely to see a big unlock in terms of pent-up demand. Because every time, he says, you see the 10-year Treasury flirt with around 4%, you see an uptick in mortgage refinancings and first-time homebuyer applications. So he thinks these businesses are really good values, and that when we've kind of cycles like this and we've seen mortgage rates fall, these companies have sort of a coiled spring kind of dynamic going on in terms of the margins they can earn. So these are not sexy companies, but they're companies that are embedded in our daily lives. You paint your house, you fix up your deck, you do all these things. And he feels like a lot of people aren't focused on this area. He blames it mainly on because so much money is flowing into the same 10 to 12 names, tech names in the S&P 500. He thinks that if interest rates go lower, these stocks will do well, and also it'll lead to, as many people think, a broadening out of what actually works in the stock market.
Did he mention any stock names to you, Suzanne, when he talked about this?
He doesn't mention stock names just as a matter of policy, but I can speculate about what I would imagine they are. I mean, my guess would be when he talks about dominant companies in paints and coating, it makes me think of Sherwin-Williams. That's a very big name here. And then when I think of the sort of what we call sort of category killer big home remodel and repair companies, I think of the likes of Home Depot and Lowe's. So those would be my guesses, but they are not names that he gave me.
Okay, interesting. Right, onwards. I talk about why you and I are going on holiday with Nick and his $1 million.
Well, I really loved his idea. Well, I love the idea of giving money to kids. His idea, again, he's really into experiences, and he would take his family, 10 to 12 members of his family, particularly his parents who are in their mid-80s, on one of those around-the-world high-end private jet journeys where you just jet around in your own private jet, and he would go to all these bucket list destinations that you would like to go to, but that take you a lifetime to achieve, So he'd go to Angkor Wat and Machu Picchu and Nepal and India, and he'd go to Uganda to see the mountain gorillas, and to Japan, which anyway, I I love this
He
idea.
says he's doing it in 30 to 35 days, Nick. Come on.
Yes.
I mean, Machu Picchu, by the time you finish queuing for tickets, you're 2 days in.
Well, Merryn, we only gave him $1 million. So he actually priced this out.
Did he?
And he figured it would take him about 30 to 35 days. And he factored in the number of people. So, he could only take 30 to 35 days if we're only allowing him to splurge with $1 million.
I tell you what, 35 days on a private jet with your family, maybe it's enough.
Oh, that's a really good point, Merryn.
That's enough.
I think I might pay to break up that trip.
Maybe we will go for 5 days each. I think it would be absolutely wonderful, though.
Oh, I love this idea.
Although I'm interested in the jet. How far can it go? The details. It would be wonderful. Okay, so there you go. Metals, healthcare, lots of property. Give money to your kids and get yourself a private jet. And that's what you do with $1 million these days. Suzanne, thank you very much indeed.
Thanks, Merryn.
Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review, and subscribe wherever you listen to your podcast. This episode was produced by Summer Sadi and Moses, and questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.